sides. So a buy and call. I believe this will be a clearer example. When you buy a call, remember these few points. It gives you the right, not the obligation. Your risk is limited to the amount of money, the premium or the money that you pay. Because as a buyer, you pay, right? If you decide not to go with the contract, the money that you pay upfront, is just given, it's just collected by your counterparty. But in theory, your profit can be unlimited because let's just say this, in the open market, the stock that you're looking at is $55. And if you, to enter into this contract, you need to pay $5. Your premium is $5. That gives you the right to buy this stock at $50 30 days from today. So if 30 days from today, the stock price increases to $100. So your buy call contract allows you to buy low at 50 and then potentially selling at $100, or when the stock price actually reaches $200. So that's why I say your profit can be unlimited potentially. Because what if your stock turns out to be something like a Google? Your Google is almost $1,600 per stock. Let's just say theoretically, if you have a buy call contract, you buy a call option that allows you to buy that stock for only $50, and then you just hold on for a few months. You see the stock price shoot up to 1,005. Can you imagine what is your ROI? Right? So this what a buy. So if I want to explain very simply, is using one sentence, buy call is like buy low, sell high. Right? So that's I think that's when I say this is probably something that you can actually understand very well. Sell call means what? It means that you are obliged to sell stock, right? So why do you even sell call? Now, let's put aside naked call, okay? Let's put aside naked call. Let's just say, why do options traders even do sell call? If I own Apple stocks, if I own 100 Apple stocks, for example, I can use sell call as a strategy to earn extra pocket money every month. Because I already own a stock, I have protection in the sense that I'm not selling naked. I have a stock to actually fulfill my obligation if my sell call contract goes against me. For example, if the current price is 55 and when I sell a call, I collect $5 premium. $5 times 100 shares, it means I have extra pocket money of 500 for that month. Let's say in a month's time, if the stock price drops to $45, if the stock price drops to $45, I as part of my obligation, I'm required to sell away the stock that I own. Okay, so if I don't have the stock, then I have to go out and market and buy. But if I have the stock, then I'm covered. Though this is what we call covered calls, because you're not selling naked. I'm not selling naked. Again, like let me say, I sell call. I do not sell naked call because I do not want to take any more risk than what I am prepared to take. When I own the stock, I can use call as a strategy to earn extra pocket money, to earn income. So the one of the basic premise of sell call is really to get extra money, and especially when you already own a underlying stock, rather than let a stock sit in your portfolio and just wait for a dividend payout at the end of every quarter. But what if the stock that you earn does not have a policy of paying out dividend? Then this is another way for you to earn recurring income. You can actually sell monthly call and get extra pocket money. Okay, so what if your sell call option turns against it, the trade turns against you? You just suck thumb and sell away your underlying stock. nothing much happens to you, because in a sense you already collected $500. The $5 premium times 100, you already collected $500 premium upfront. Maybe and when I sell a call, you will typically still try to also enter into a contract where the strike price, instead of $50, maybe you already bought this underlying stock for $40 some months back. You enter into contract doesn't mean you have the strike enter the same strike at $40. When you enter into a bought the underlying stock a few months back, some time ago at $40, you already can actually enjoy some capital gains already. Maybe not a lot, okay, but still you may not be in a losing proposition, right? So you can potentially get capital gain because you enter and the strike price is higher than the price that you acquire the stocks to begin with. And on top of that, you actually have collected $500 money upfront when you sold the call option. So again, let me just do this sanity check. Everybody okay so far? Now over here, when I say unlimited loss, is the stock, well, theoretically it's not unlimited, it's maximum. The right term to use would be maximum loss. What if the stock price drops to zero, the whole company goes bankrupt, you get nothing. But well, minimally you would have already collected $500 premium at at the point in time when you sold this contract. So there are rationales for each of this option strategy, and as long as you know the rationale, you have a clear idea of your trade plan, and you know what are the risk mitigation measures you put in place, you are okay. The risk mitigation measure in this context, I'm referring to not selling naked call. Okay, please do not follow my example and by doing a reckless trade, not owning any Tesla shares stocks and then just sell it and then lost 50,000 in one night. So never do. If there's anything that you want to take away, is about do not sell naked calls, please. Now buy puts. Again, when you buy, it means that you are a buyer. As a buyer, you pay money, right? What is the risk to you? The risk is the money that you pay in this $5 times 100 shares. The worst that can happen to you is you lose the $500 that you pay. Now the $500 is to allow you to have the right to sell your shares if the market price of your shares drop to below a certain level. So let's just say, as an example, if you own this particular stock, and you want, let's just say end of the year, you want to maybe sell this stock away because you think that, okay, I need to take some money out to buy Christmas present for my family. I want to pamper my family, whatever it is. But you want to have some assurance that you can still sell at a minimum price. You can still sell at $50, even though the price then, in case it drops to $49 or $48 or $47 or $45, doesn't matter. You pay $500 today to give you the right to sell the stock at $50 1 month from today. So what happens is 30 days from today, if the stock price is above 50, you can choose not to do anything, because you don't even need to do anything, because you can just simply go out in the market and actually sell it at the market price. Maybe you actually earn even more. But if the stock price actually drops to, let's say, $49 or $48, you, by buying a put, you actually gives you the right to actually sell at $50. So you can actually still sell at $50, and let's just say you bought a stock at $40. So you already would have realized a capital gain of a certain capital gain. So it gives you the kind of protection. So buying a put is really about buying insurance. So that is how puts work. Buying puts work for traders or investors who are more sophisticated. Now sell put, I said a few times already, I do engage in quite a fair bit of selling naked puts because my premise is as follows. I sell puts only on fundamentally strong companies or stocks. I am prepared to buy the stock if the trade goes again, if I get exercise. So I need to have enough capital to do that. So, and I collect, if nothing happens to me, I get to earn extra pocket money. How much is the pocket money? The put premium means I get paid $5 for selling put. $5 times for that month, I will get $500 to as my primary recurring income. So sell put allows me or binds me to the obligation to buy the underlying instrument if the price drops to below the strike price, meaning to say that even if it drops below the break-even point of $45, because I I get to I will get to buy the stock at $50, or I'm obliged to buy the stock at $50, but my effective price is not 50, it's actually 45 because I can actually use the premium that I collected to knock off. So my effective buy price is at 45. So and I get the advantage of buying the fundamentally strong stock, and I get to own it. So that's, and of course the other reason, as I said before, I get to, the premium that I earn becomes the income that I use to generate as monthly income, or for most of you, for recurring secondary income.